this is kind of the exciting part for me because I always think about this in terms of innovation. And of course, as a journalist, you get so much more play when you talk about robotics and robo-advisors and artificial intelligence. But I want to start with you, Manooj. In terms of your job at DWS, in terms of your job as a big asset manager, what do you do in the ETF space there?
So I'm responsible for the ETF business. We are second largest issuer in Europe. And my job is a combination of making sure we offer good performance, good products to our clients, also oversee the innovation, product development, making sure we deliver products that are useful to our end clients, and also keep pace with the changes in the industry. As an industry as a whole, we're going through a lot of changes, and it requires myself, but also my counterparts within the organization, covering technology, other areas, to make sure that we stay relevant and also competitive in the overall market.
And Alex, at Scalable Capital, what's your role in the ETF value chain?
Well, we basically see ETFs as our investment product. So we offer globally diversified ETF portfolios to our customers. And of course, that includes the distribution of them. It also includes selecting the best ETFs, what we believe to be the best for our customers. And it allows us to very easily and very cost efficient create individual portfolios for all of our customers, where ETFs, of course, play a major part of.
So, and innovation obviously is kind of the keystone of your business. How do you see ETFs being invested in for investors? I mean, who are your customers, first of all?
Okay, yeah, so...
and how do they use Scalable Capital?
Yeah, so we are a digital wealth manager.
Right.
So we allow our customers, retail customers, to invest into the capital market. So we build, as I said, globally diversified ETF portfolios for them, and we manage tens of thousands of those portfolios at scale in an automated fashion. That's what we do on the B2C side. We are also engaging on B2B partnerships. So essentially, we are a tech company that's building a wealth management platform. So we're also partnering with other banks and financial institutions where our role might be somewhat different to what it is when we interact with the retail customers directly. But yeah, in our B2C business, obviously, what we do is we help our clients invest money in a very cost-efficient, very transparent, and very convenient way. Because right now, what they are faced with, next to very, very low interest rates, obviously, on their accounts, is the challenge to find a good way to access the capital market in an easy and convenient way, and that's exactly where we step in.
Okay, so I mean, I would think that retail investors accessing ETFs that way is really the future of growth. But we've heard in the first panel that you've even got the other side, the extreme other end of the spectrum, using ETFs, pension plans and central banks. You have such a wide net then in terms of the customers for whom you're issuing these ETFs. How do you decide in terms of what kind of products you want to offer?
It's listening to client feedback, listening to...
Who are your biggest clients? Who are the clients that you touch base with the most?
So within Europe, the landscape is dominated by wealth managers, private banks, multi-asset fund of funds, but you also see institutional investors like pension funds and insurance clients also using ETFs as part of their portfolios. I think the difference between, say, the US market and the European market is that the European market started as very much an institutional play, and the penetration of pure retail is quite small. However, with the emergence of robos and also other platforms, the retail investor can now have access to the same sort of institutionalized investing which the large pension funds, etc., are doing. So it is very much as what Sean said at the beginning. ETFs have kind of democratized investing. It's the same instruments which are used to offer solutions to the biggest pension funds and insurance companies down to the private investors like you and I. And what we see is that with the emergence of especially, say, robos, but also within, say, private banks and wealth managers, many clients are sort of moving to a asset allocation view. So they will maybe, each client will have maybe 20 buckets for asset allocation, and then within those 20 buckets, they want to select the ETFs, which are the most relevant. So we heard earlier about due diligence is important. It is, because you need to look at, is it the right benchmark giving exposure to that bucket? Is it also the right replication structure? Is it swap-based or physical replication, which we can do in Europe? Also, is it the right in terms of the tax structure? So in Europe, it's a very fragmented market. A fund domiciled in Ireland could have tax benefits over a fund domiciled in Luxembourg. So as part of the due diligence, you also need to take this into account. Also, you need to look at fees. That's an important component. Obviously, many people will look at what the headline total expense ratio is, but even more important than that is you need to look at the performance. Look at the performance after costs. Look at the total cost of ownership. And once you can tick all those different boxes, you can then find that your product can go into those asset allocation buckets. I've been in the ETF industry for almost 20 years, and the first few years was very much, yeah, let's try it out and see whether it works. And then we went through a phase, especially probably 10 years ago, where there was a lot of innovation happening in the product space. And there was a lot of products which people thought were good ideas, but they didn't actually stick with the end investors, because at the end of the day, there's a lot of sort of investors who just wanted simple beta products. And we've obviously seen the emergence of things like smart beta over the last few years. I still think the jury is out in that category, and I saw in one of the surveys that people still think it's an area that can grow. But I would see something like smart beta in the same space as traditional active asset management, because there you need to look at the track record. How does the product or the fund perform over different financial or economic cycles? If it comes out of it good, then that's brilliant, because that's a solution. But what we also see is with the emergence of robos, but also how clients do their asset allocation, more and more clients are just making, the value added is in making the right asset allocation tool. And we as ETF providers need to make sure that we provide the right products in those buckets. And obviously there is some innovation. So I like the example of the slim ETF, but something like that is very, very niche. And it either catches on or it doesn't work. So, and as a product provider, we have to make the judgment call in terms of which segment of the market we're aiming for and how you calibrate it. So long story short, we sort of observe what's happening in the market, and we try to make what we do relevant, but for the overall market. But obviously we listen to institutions. Our strategy is less retail at the moment, because I think that breakthrough will now happen once MiFID II comes in, but we then will have to recalibrate our approach for the retail market as well.
We saw, by the way, when Athanasios showed us the themes, the marijuana-themed ETFs are getting a huge, maybe they're doing better than the obesity ETFs even, or maybe they contribute to the obesity ETFs. When we talk about education, and surely fees and performance is something, Alex, that you have to show your customers and that they care about. You have to make that easily transparent for them. But in terms of the other minutia of how these ETFs are operated, we were comparing it earlier to car engines. Most consumers don't know the difference between how a diesel engine works compared to how a gasoline engine works. And surely they don't want to know the difference. How do you ensure that they don't have to go and look at how providers actually put ETFs together and have APs at the ready in case they need them? And I mean, these are the kind of things that most retail investors don't need to know or want to know.
Totally agree, and I think what you have just listed out as important aspects of a fund due diligence, that's one of the cornerstones that we offer to our customers. So who out there as a retail investor is capable, is willing, has the time to actually do this kind of due diligence on hundreds, thousands of potential products? And so we employ a whole team that monitors the market, that constantly looks out for new offerings, for better funds that match our criteria. And when we see something coming up, we invest the client's money in those funds. So our customers, they don't want to care about this. If they want to know about it, we're fully transparent, and we see that this happens. We have quite a lot of very well-educated customers from the financial services scene. Maybe some of you might even be customers at Scalable Capital. So if you want to find out about it, if you want to know more about it, you can see it, you can engage with our support team and actually have quite an educated conversation, discussion about why we picked this ETF versus another one. But the vast majority of customers, they just want to know that we are doing this, that this is part of the offering, of the value proposition, and they know they're in good hands, and that's it.
So I'm sure both of you are responsible for doing due diligence. Obviously, you're putting it together, and you are responsible for that for your clients. Do you run into issues when you don't see that kind of transparency from issuers?
Well, I mean,
Lee was telling us that she called an ETF manager and asked what's in the basket, and he said, why would I tell you?
Yeah, I mean, I think our sort of thinking is if we don't understand it, our customers will not be able to understand it as well. So we're really seeing ourselves as the advocate of our investors, of our customers. So we always have to be able to fully understand the product, to be sure that this is a good product, and we have a formalized process for that we're also very transparent about towards our customers. And if we don't see all of those boxes ticked, then of course we feel less certain that this would be a good opportunity for our customers to invest in.
How do you guarantee that kind of transparency? And what do you do in terms of, say, an active ETF?
We don't offer any active ETFs, but the philosophy behind X-Trackers and DWS has always been we've nothing to hide. So we're fully transparent. We were the first issuer back in 2010 to publish all the constituents of our swap-based ETFs on our website and showing who the counterparties were just after the financial crisis. And even now we show who the securities lending counterpart are. So I always say that if a client wakes up in the middle of the night at 3 a.m. and really worried about their investment, they can go on our website and have a look and see all of this and then hopefully be comforted and go back to sleep. But the onus is on us is very much driven by regulation. So within Europe, you have the framework of UCITS. And UCITS is, and with all due respect to the US, a very robust set of regulations in terms of how funds should be managed. I think probably more robust than 40 Act because you have a lot of exemptions. But with the UCITS, it's very clearly laid out in terms of if you're using derivatives, if you're using securities lending, what the limits are and how you should provide transparency. So from my perspective, as I said, nothing to hide, and we're very transparent. At DWS, once a quarter, we actually host a client due diligence event. So clients are invited and then to look under the bonnet, and we'll lay open the PM team, compliance, risk, so they can understand the whole framework. And obviously, there are a lot of front office functions, but the infrastructure behind it is equally important as well. You want to make sure that if a portfolio manager puts on an instruction for trading a basket of securities, that they get executed efficiently. You want to make sure that there are countermeasures in place to pick up a mistake by a portfolio manager. And that's where your infrastructure is also very important. And also that's where you can use technology to improve your offering as well.
And we talked about, there hasn't really been a long-term capital management or a Woodford event in the ETF space, but there was, for example, around the flash crash, a time when there weren't enough APs or they weren't doing their job, right? Do you, at DWS, try and make sure that you have somebody ready to pick up the slack if it's necessary? I mean, Have you run into situations where it was a concern?
Yeah, so in common with all the other ETF providers, we have a capital markets team, which faces off to the sort of the sell side and the market making community. So in Europe, it's quite common for a provider to actually nominate official market makers on each exchange, and we will actually pay for that service. So we make sure that across our product range, we have a minimum of at least 2 market makers on the relevant exchanges where we are trading. And we also make sure when we choose our market making partners is that we pick them for their strengths. So if they're weak, for example, in high yield, then we'll make sure we don't have them quoting on our high yield products. But if they're strong on US equities, then they will cover that. So we try to make that, and we have a sort of a formal relationship. But also what you see is that in Europe, sort of size and liquidity are kind of self-fulfilling. The bigger a product gets, the better the spreads, the more clients are drawn in as well. And that also draws in more APs and market makers. On our X-Trackers platform, we have over 40 authorized participants who are lined up. And from that, we have about 6 or 7 official market makers who provide liquidity on the various exchanges where we're listed.
So Alex can sleep better at night, and his clients can as well. What do you pitch a customer on, a client on, when you're talking about your use of ETFs? I mean, your cost is X% lower than what, mutual funds, and is performance also, do you think, better because obviously the cost is lower, but do you just pitch the same passive case, or what do you tell someone who's a prospective?
Well, cost, of course, are a very important aspect of that. Transparency is another one. So we want our clients to understand the products that they invest in. And an ETF is a very easy, a very simple product to understand. But besides that, of course, we're also pitching to our clients that by using ETFs, it's very easy to build a good, well-diversified portfolio among many different asset classes, among many different regions. And that, of course, in the end has a positive impact for them again, which lowers costs, which makes it easier for them to invest with us. So that's one aspect. However, the other aspects that we see that are being well appreciated by our customers are the whole digital experience. So being able to become a client, to become an investor in the capital market within just 10 or 15 minutes at any point in the day, on the weekend, it doesn't matter. Being able to get that in a purely digital fashion, no papers, no wet signature whatsoever, that is well perceived by our customers. And I mean, we're not talking about, let's say, Generation Y customers, right? So if you want to invest money, of course, you need to have some money. So our average customers might be older than what is expected. So we see a lot of our customers being 40, 50, 60 years old. But it is well appreciated to have a fully digital process by them as well. And the next thing that they appreciate very much is the whole personal interaction. So we are there for them if they have questions, right? If they wake up in the middle, well, not in the middle of the night, but let's say early on in the morning, they can reach out to us. We have multiple channels for them to talk to one of our advisors, and that is well perceived. So ETFs are an important aspect of it, but there are multiple cornerstones.
The poll question, I'll just put to the audience, and you can answer as you take your time, but I want to put it to you as well, Alex, which is, do you consider artificial intelligence an innovation in investing, or is it an innovation in marketing? It's a little bit of a cynical question, maybe, or maybe artificial intelligence could be helpful in marketing as well. What do you think about that? Probably both, right? So, of course, we do see that the keyword of artificial intelligence, machine learning, is being picked up mostly by the press, by forums in a positive way. We also see it as a potential in investing. We try and we look into ways on how we can employ it on our side as well, but we also have to be quite honest and open that, of course, artificial intelligence right now is not fundamentally changing much yet. It has a huge potential. We're constantly looking on how we can employ it even for smaller things, but it's not the revolution. The revolution is not there yet. Speaking of, I got an interesting tweet earlier, or the forum got an interesting tweet from someone in the audience. I'm not sure who it was, but I'll read it to you, and then Manooj, I wonder what your take is. Someone says, terribly dull and uninspired conversations. Little does this room know, all ETFs will be crypto assets with crypto asset underlying. What do you think about that? I mean, look, the blockchain is certainly proven important to banks around the world. There's a new cryptocurrency being used by, I think, 18 banks, Universal Stability Coin or something, and the price of Bitcoin has gone up a lot. We have all heard about Facebook's Libra. Is the future of ETFs crypto-based?
Definitely not.
No?
No. It's about sound investment solutions for people saving for their pensions, saving for their children's weddings or education. Crypto isn't the solution. I think it can play a part, and the technology behind it can improve the process from both a investment perspective, but it's also can improve the process for the likes of Alex's firm to help in terms of determining how you invest. But at the end of the day, your core investments into equities, fixed income, commodities are going to remain. And we need to make investment decisions based on that. And we need to be able to use the right tools to deliver those investment solutions. I think where all the new technology can play an exciting role is in terms of making it cheaper for the end investor. So I think one of the things we see is that obviously there is a lot of margin pressure in the asset management industry, and until now, that margin pressure has been borne by the providers, by the asset managers. It's initially in the passive space, but we're also seeing it in the traditional active space. And the next step will actually be when that margin pressure comes down on the distribution side. So I think until now, the distributors have actually been insulated from that margin pressure because they're still adding value to their clients in terms of selection of funds or ETFs. But if the technology can help the distributors to become more efficient, then they can pass on those cost savings to the end investor. So the end investor finally benefits from an overall cheaper investment, and then their returns will improve, and they can have a better retirement fund or whatever because you're saving money as you go along. So I think this change is going to happen. I think everything you read and everything you see, and I'm not an expert on the technology, but it's heading in that direction. Asset managers like ourselves are starting to adopt it in terms of how we can use it to help the investment process, how we can improve things like trading, improve compliance checking. All of these things, the technology can actually help you do that, and that brings down the costs, improves overall market efficiencies, and give the investment universe better products overall, and hopefully make it easier for Alex as well.
All right, well, very fitting to end on low-cost focus as we're at a Vanguard event. Thanks so much for joining us. Really appreciate it, Alex and Manooj.